Welcome to Oregon Cash Flow Pro. My name is James Barber. Today we're going to be talking about IULs. We always hear IULs are so expensive. Either they're expensive up front or they're expensive later on, and you should just avoid those expenses. There are other things we can do. So are IULs actually expensive? Let's dive into it. Keep in mind, expense is relative. We got to look at what we're actually getting for what we're spending and then determine, is that more expensive than what other options we have available? But when it comes to the IULs, there are some that are definitely what I would consider expensive. And then we have other ones that we can optimally design to minimize the expenses. Let's take a look at an example. First, let's look at an example of one that is expensive. Here we have a $1.1 million death benefit. This is a 45-year-old male. I just ran a couple of illustrations with two different products, both with $1.1 million death benefit and the ability to put in a little more than $70,000 a year into each of these policies. These are the expense pages that we're going to be looking at. Now, every IUL costs a little bit of money to get that into the product. That's called the load fee or a premium charge. In this case, this particular product, you put in $71,000 and the load fee is going to be $4,313 every single time you put it in. I don't worry too much about the load fees as long as they're consistent and they're not too high. Essentially, we see load fees in the range of 4 to 10+%. We would love it if they were all around the 4% range, but most of them fall in the 5 to 6% range on a consistent basis. And that's okay. We can make good money in an IUL even with a 6% load fee. Even with the higher load fee than that, it's possible to make money, but the greater the expenses that you have, the more risk that you take on as to how long it takes to pay back that particular load fee. So this one's not bad at all. This is a decent load fee. Next, we have your cost of insurance. There isn't a whole lot you can do about cost of insurance because you have to pay for insurance in order to own an IUL. That's what makes it tax advantaged. When you own a life insurance policy, the growth inside of it is tax deferred and potentially tax-free. Eventually, the death benefit's tax-free, but we can access that cash value tax-free because it's life insurance. So there's going to be a cost of insurance. The question is, can we keep it reasonable? In this situation, $1,000 for the first year. It does go up every single year because the insurance inside of an IUL is annual renewable term insurance. So it can get expensive down the road as you get older. The key to owning the IUL and optimizing for cash growth is that when we get old enough, when we get to retirement, before we get to a point where that insurance is what we would normally consider expensive just to pay for that cost of insurance, meaning if I want to put $50,000 into a policy, am I going to have to pay $20,000 just that year for the cost of insurance? That would be very expensive. We want to avoid situations like that, but we don't run into situations like that until really you get into your late 80s. As long as we reduce the amount of insurance that we're paying for inside of these policies before we get too old, usually we look to do it sometime in the late 60s, mid to late 60s. The cost of insurance can stay pretty reasonable compared to the overall value that we have inside of the account. So cost of insurance, not too bad in this particular policy because we do have a substantial amount of money growing inside here. In this case, over 10 years, you've put in $718,000 and the cost of insurance is still $2,500. That's a tiny, tiny percentage of the amount of money you have inside this policy. Now, on a per year basis, if you're putting in $70,000 and the cost of insurance is $1,000 or $2,000, that's still a pretty small percentage. We're talking 1 or 2%. We're talking 2 to 3% of what you're putting in that year. But we can't just consider what we're putting in that particular year because the benefits of these come over time as we accumulate that cash value, because that value is protected from going down based on market returns. The only way the value inside the IUL goes down is when we have high expenses and those expenses come out, but we don't get credit in the market. All right, moving on. This one doesn't have any riders that have a cost to it that we've attached. There are some that we could. We generally don't look to do that. The only rider that you're going to see in an illustration that I do that might have a cost to it will be when we can blend in some supplemental term insurance. And we'll see that in the next illustration I show you where we've drastically reduced expenses. Now, this product does not allow us to blend in supplemental term insurance. So what we see here in the additional expense charges is a pretty hefty cost, $4,400 for that first year. And basically every year for the next 15 years, it's at least that much, and it ends up going up over $5,000. This is what I would consider expensive. It doesn't mean that it can't be a successful product and you can't make more money than what you're paying out in expenses. But the expenses don't have to be this high to get into a good IUL product that has great growth opportunity and still gives you that downside protection. Now, in this situation, for 15 years, if you're paying almost $5,000, let's say the average is just under $5,000, that's nearly $75,000 in expenses over those 15 years, not counting the cost of insurance. The cost of insurance in this one is also about an average of $2,200 per year. So there's another 30 plus thousand for the cost of insurance over those 15 years. Altogether, we're well over $100,000 in expenses over 15 years. Now, we've put over $1 million into this policy, which means the expenses are north of 10% after 10 years based on what we've put into the policy, not counting the load fee. We've also put in about $65,000 in load fees in this. So now we're at $175,000 in expenses, and we've paid in a little over $1 million. This equates to about a 16% expense in relation to what we've paid into the policy. I would agree with anybody. If they complain that that's expensive, we're in agreement. We're definitely in agreement. This is an expensive policy. Doesn't mean it can't work out. We do see the costs drop right here, beginning that next year. And that's essentially where the insurance company is recouping the commissions they paid out in this policy happens during this 15-year period. In this particular policy, because they don't allow for a blended design, the commission on this design is well over $20,000 for the agent. It carries a lot of expenses because of those costs. You can see the account value that first year. If you get a credit of $4,000, the account is still $5,000 below what you paid into it, a little more than $5,000. But the actual cash surrender value is well below half of that. That's because there's surrender charges. When they've spent a bunch of money to sell you that policy, they're going to make sure that they can recoup that. So you have to keep that policy for a certain number of years until they recoup all of those expenses, because they're not just going to charge you that all in the first year. Otherwise, you really wouldn't be able to grow your account very quickly. So it's a lot less attractive if they charge you everything up front. Okay, this is definitely an expensive policy. And the people that are out there and complain about IULs, this is like the poster child for those complaints. And I would agree with it. This is an expensive policy. We can do better though. And this is where I specialize. We design high cash value policies where you can dump a ton of money into them at a much, much lower expense. We still get that downside protection, but we have this incredible tool that grows our money tax deferred, is downside protected, has very low expenses, and we can access that cash value, a much, much higher percentage of that cash value than in this particular type of design. Let's look at this other one. Okay, here's another policy. Same 45-year-old male, same health rating, same death benefit. Except in this one, we can put a little bit of extra money into it. So why not? Anytime we own a cash value life insurance policy, the best thing that we can do is to put as much money into it as the government will allow. How they determine that varies based on a number of things, but in this particular situation, just know we can put a little bit more into this policy for the same design as that other one. That's not really the selling point here though. Let's look at the actual charges. Here we go. This one, they call it the premium charge instead of the load fee. We're putting in a little bit more money, and in the first year, we're going to pay a little more than we paid in that other policy. But then after that, we're putting in a little more money and we're paying less. So this one has a slightly lower load fee. The load fee happens to be 5% on this one. In the other one, I believe it's 5.5% every year. In this one, it's 9% the first year and then 5% every year after that. Again, load fees, one-time expense to get the money into the policy. So I don't worry too much about the load fees. We can easily make that money back off that load fee. If we don't put any money in a given year, that expense isn't there. And we see that happen down here in this particular illustration. You don't put any money in, there's no load fee. It's just a one-time expense. And from there, our money can only go up based on market returns, but it can go backward based on the other expenses. So what do we have for the other expenses? We have a documentation fee. That's every year in the policy. That one doesn't change. We have a per unit charge. This is where they're going to recoup the commissions. Notice it's not $4,000. It's only $600. And over the course of the next 15 years, the total expense is only $9,700. Remember in that other one, this totaled up to $75,000 plus, where they're recouping all their expenses. In this one, $9,700. Now, this is because we're allowed to do a blended design where we're going to blend in some supplemental term insurance, which is actually the exact same type of insurance as the base term insurance. It's all annual renewable term. The only difference is it doesn't pay anybody a commission. So the cost of that insurance is put into this rider charges column. So for the cost of insurance, we're just going to add these two columns together. Our total cost of insurance here in the first year, $630. Over here on this one, we were at $1,000 in that first year. All in all, when we get down 15 years into it, our total expenses, instead of being over $175,000, when we account for the load fees, our total expenses is just under $90,000. When it comes to all of the expenses except for the load fee, it's just over $30,000, or an average of $2,000 per year. That's a far cry from this one, which is closer to $6,000 and $7,000 and $8,000 a year throughout this first 15 years. Big difference. So about $2,000. If you don't put any money into this policy, your expense is $2,000 for the rest of the expenses, approximately. Let's look at that in relation to the value in the policy. We're in the first 15 years. Let's go 5 years into it. We've put in $373,000. If I don't put any money in that next year, and the expense is $2,000, that represents a 0.5% expense ratio. Now, this particular product, the index options I'm using have a 1% guaranteed bonus. So even if the index returns nothing, that 1% bonus is going to cover all of the rest of the expenses and give me credit above and beyond that. This is what I consider a great design and a great IUL with low expenses. I don't consider this expensive at all. This is the type of product I want to own. And in fact, I do own nearly this exact product. I'm not 45. I wasn't 45 when I bought it. I picked it up last year, a little bit ahead of schedule for my overall portfolio and plan. So we haven't max funded it just yet. But what I did was I locked in that first year. I paid the minimum payment, which means I minimized the load fee during that first year. And we're just starting year 2 on this particular policy. Now, in year 1, I happened to get a little over a 7% credit. So I would have recouped almost the entire load fee had I max funded it that first year. But we didn't. Still nice to see a good return over that last year. And this now has the ability for me to dump in a bunch of money at that 5% load fee. And that's what we plan to do with our particular policy. But just know that these expenses are very low. Now, the IUL in general, most of the time you're going to hear a complaint. They just get expensive when you get older. Do they really? Now, remember, we're going to manage that cost of insurance. Meaning, when you're done funding it, in this scenario, I'm done funding it after age 65. When we're done funding it, we're going to reduce the amount of death benefit we're paying for. We started out paying for $1.1 million in death benefit. Let's go to a ledger that shows me how much death benefit we're paying for when I reduce it. So right here, we don't put any money in. We switch it from an increasing death benefit to a level death benefit. You can see here at age 65, the difference between the cash value, this is our cash value column, the difference between the cash value and the death benefit is $1.1 million. That's our original death benefit. The total death benefit right now is all of the cash that we've grown in the policy and that $1.1 million. So if I were to die that year, my beneficiaries are going to get every single penny of cash growth that I got in that policy, minus the expenses, plus the original death benefit. Now, the very next year, you can see we reduced it. It went down to about $650,000 in death benefit. And we do that to reduce the expenses. I've built up a ton of cash in here. That's plenty of cash to pass on to my loved ones. So we're not too concerned about paying for $1.1 million in death benefit. Let's see what that does to the cost of insurance. The year prior, when we were paying for $1.1 million, our total cost of insurance, add these two columns together, cost of insurance and the rider charges, add those two columns together, we were at about $3,300. We dropped that down, and normally annual renewable term insurance gets more expensive each year as you get older, because the cost of that insurance is based on what's the likelihood you're going to die that year. Well, the older you get, the more the likelihood you're going to die, so it gets more expensive. But we reduced what we're paying for, so now the cost is just under $2,000. It's going to continue to go up, but my cash value also goes up. What was the cash value we had at age 66? Oh, and notice the only two expenses, the documentation fee and the cost of insurance. So from this ledger here, we're just going to look at the policy charges are now reduced to effectively the cost of insurance. We have $3.2 million in this policy, and our cost just over $2,000. This represents a 0.06% load fee. 0.06. That is a very inexpensive policy to own. And this is actually when we want to own something like that. We have millions of dollars in a potential place where we can get good growth based on the indexes, and the downside is all protected. There is no other investment that you're going to be able to take $3.2 million and have somebody else manage it, or have it in some other asset that has some type of guaranteed no losses. If you go invest it with a finance person, they're going to charge you a 1% management fee. That's way more than $2,000. 1% would be $32,000 that they're going to charge you just for that year to manage that money. They can't give you any downside protection for that either. They just don't have the ability to do that. So in the IUL, we have really good growth potential, guaranteed 1% return, and our expense is 0.06%. We have guaranteed 1% when we're using that 1% bonus option. Well, 1% bonus option is $32,000. Granted, that's not very much growth based on 3.2 million, but that would be worst case scenario when everything else is down and your principal is protected and our expense was super, super low. So this is when we want to own these policies, is when we get into older age, because nobody else is going to manage our money as effectively as that. Now, maybe you manage your own money, but you got to recognize as you get older, your ability to use math and do your own finances reduces. Are you going to have the skills necessary to make sure that you're not going to lose money in any given year? I mean, you can't even guarantee that right now. Most likely you've experienced some losses out there. So this is a great place to diversify some of our portfolio. I don't ever advocate for putting every penny into something like this. We want it to serve as part of an overall portfolio. This is a safe part, but we still get good exposure. In this particular IUL, we get exposure to the S&P 500 via the futures, and that's uncapped exposure. We also have exposure to some volatility indexes, which will shift between equities and bonds and cash, depending on the volatility of the market. We also have some blended index options that will have a little bit of the S&P, a little bit of international stocks, a little bit of bonds, and a little bit of small cap. It's a really well-diversified set of index options that are all uncapped and come with that guaranteed 1%. Let's flip back one more time to the expensive one. Notice the expenses in this particular column never go away. Well, this particular product charges essentially an annual 0.09% annual account value charge. Remember, our entire cost of the policy, when we get to where we're going to reduce that cost of insurance, our entire cost in the other product was about 0.06% for an expense. In here, we've got 0.09 guaranteed off of these. And they actually reserve the ability to increase that because it could go up to 1.5%. This product can get expensive. And then we also have the cost of insurance. That's not even accounting for the cost of insurance. And they're charging more for that cost of insurance here as well. So expensive product, inexpensive product. Big difference. I nearly forgot to show you. Let's look at the cash value available at the end of that first year in this scenario. Still have the assumed credits, but look at this cash value after the surrender charge. The surrender charge on this one is only about $4,000, a little more than $4,000. Remember, in the expensive policy, that surrender charge is about $35,000. The surrender charge is not something that you're going to incur unless you cancel the policy early during the surrender charge period, but it does impact your access to that cash value. Having access to that cash value is key to how I utilize the IUL inside of my overall portfolio. Now, you may not want to do this, but consider that this cash value works like a line of credit, and it's available to you to help you throughout the whole time you're alive. You don't have to wait until you're dead to take advantage of the benefits of what these policies can do for you. Now, in my particular policy, remember, I own this design. Cash value that I have available in here, I can borrow with no effect on the growth at 5% interest for the life of this policy. Anytime I want to, I can borrow, and it only costs me 5%. Now, if you've paid any attention to my channel, you would know that I do challenges regularly where I borrow a chunk of money from my life insurance policy and we put it towards an investment. We only need to beat that 5% cost of borrowing from our policy to make that outside investment worthwhile so we can send the money back. Now, there's tax consequences and other things, so we generally want to do better than that. But essentially, if I can borrow at 5% from anybody, and I don't even have to make an interest payment. When I borrow from the life insurance company, I don't have to make an interest payment. That 5% interest will just get added to the line of credit and added to that loan if I don't make the payment. That means I can engage in investments that might take a while to pay off. I don't have minimum monthly payments, and I don't have to make that interest payment. So it works out really good that I have a policy that has very low expenses, will only go up when the indexes go up, and will only go down by the expenses in a 0 year, except for that guaranteed bonus that I have available here. And you have a huge portion of the money you're putting into this policy available to still borrow. It's liquid. I value liquidity so much in these things because we can do really good with some of the things that we're able to do inside of the stock market. It makes it very easy for me to be able to take that loan and multiply those dollars and beat that 5%. Not everybody has those skills, and that's okay. Some people, they just buy these and they just accumulate inside of them. That works okay too, as long as the charges are not very expensive. It's all about the likelihood of success with these things. And if we have small expenses, the likelihood of success goes up. If we're utilizing the cash value here, while we're also getting the growth in here, I think that also increases our chance of success, depending on what you're doing with the borrowed funds. But right now, the fixed account in here is crediting at 5.5% interest. I can borrow at 5% against this policy and get that 5.5% guaranteed growth. I automatically get 0.5% arbitrage. Now, I think we'll actually do better than that in the index option. So I'm not using that feature, but if I wanted to, I could. If I was concerned about what was going to happen in the overall market, if I didn't think there was growth possible in the market, I might shift to the fixed account and still borrow against it, lock in that 0.5% gain, and I can take that money and go to a high yield savings account or a CD or a multi-year guaranteed annuity, and I can do really good, 4 or 5%. So not only am I beating the 5% inside the policy, but I'm also adding to that outside of it in a very safe manner. There's all kinds of things that we can do when it comes to utilizing the actual cash value inside of our policies. So it's an exciting product to own, in my opinion, but we definitely need to have those low expense designs to make it worthwhile. If you're in the market for an IUL, or you want to look and see if this might fit into your portfolio somehow, book a meeting with me. I do free consultations every single day. I'm available to help you find the best high cash value life insurance that you can so that you can diversify your portfolio and start to accumulate wealth in a tax-deferred product with downside protection, but still really good upside potential. I have, in my personal policies, experienced 18+% growth in these IULs. That doesn't happen every year. In fact, I've also experienced some 0 years. But the whole point of this is, in the future, 20 years from now, 30 years from now, when I've got millions of dollars built up into here, I'm going to be really happy that I get guaranteed growth higher than the expenses. And every once in a while, I'm going to get that 18% return or 10% return or 6% return. And it's only going to go up, and it will never go down, even if the whole rest of the market is crashing. That's how we diversify. So I look forward to helping you. If you're in the market for this, you want to talk to me, I'll show you an illustration. If you're working with a different agent, you want me to take a look at the illustration you got, let you know if it can be improved, I do that as well. Whatever your situation is, let's talk, and I'll see if I can help you out. Take care. We'll see you next time. The next 20 seconds determine your future. Subscribe, meet with me, or continue educating yourself with these videos right over here. I appreciate you. Now go maximize your cash flow.